For over a decade, Google operated as a highly profitable software toll booth for the internet. They built a business that turned lines of code into a relentless cash machine, requiring very little physical infrastructure to scale. This model generated so much excess cash that Alphabet routinely bought back its own stock to drive up the price. As we can see in this chart, those buybacks peaked at $62 billion in 2023 alone. In the first quarter of 2026, management abruptly shifted direction. Share buybacks instantly dropped to zero, replaced by a massive $80 billion equity capital raise that heavily diluted existing investors. This capital is flowing into an unprecedented $190 billion budget for physical AI data centers. To fund this, Alphabet pushed its long-term debt past $77 billion. In just 90 days, Alphabet abandoned its 10-year strategy of shrinking the share count. They chose to issue new shares, leverage their balance sheet, and buy physical server racks. When a company undergoes a pivot this drastic, we run the numbers through rigid quantitative standards of deep value investing to see if the market price remains grounded in reality. Alphabet fails these tests. The stock trades at a price-to-earnings ratio of 26.1 and a price-to-book ratio of 8.7. This discounted cash flow model shows an intrinsic value of $168, yet the market is currently pricing the stock at $345. Based on historical growth, buying the stock here offers a 0% margin of safety. Despite these failing metrics, Warren Buffett's Berkshire Hathaway just poured $29 billion into Alphabet. This includes an $18 billion open market position and a rare $10 billion private placement to fund their infrastructure. Skeptical, the most disciplined value investor in history just staked billions on a tech company that fails every traditional pricing model. To understand why, we have to look at what Google is actually up against. Alphabet's core business relies on a cost-per-click model built around search results, but generative AI conversational interfaces provide direct answers, bypassing the need for users to ever click on a link. Generating these conversational answers creates severe economic friction. The computational power required to produce an AI response consumes significantly more electricity and server time than a standard web search. Simultaneously, the company is facing global antitrust scrutiny. The U.S. Department of Justice is actively working to sever the default search agreements that Google uses to guarantee its dominance on mobile devices. Without proprietary infrastructure to lower these rising costs, Alphabet risks losing its search market share to more efficient AI competitors who don't carry the weight of legacy systems. The financial metrics look strained because Alphabet is fighting a two-front war, deploying unprecedented capital just to defend the economic moat they already have. We can see the results of this spending in the 2026 earnings reports, which track exactly where this infrastructure investment is capturing revenue. This chart isolates their income streams. While search revenue remains steady, Google Cloud surged 82% year-over-year, hitting nearly $25 billion in the second quarter. Alphabet is constructing the physical power grid for the global AI economy. They are treating their identity as a software network for the role of a massive physical utility provider. A $190 billion entry fee creates a definitive capital moat. Only a handful of sovereign entities or mega-cap peers have the resources to build a competing physical network at this scale. Buffett and the elite asset managers are securing a stake in a monopolistic global digital utility, viewing the current market price as a fair entry point for a critical piece of global infrastructure. This strategy introduces a new kind of risk. Alphabet has traded its flexible software profit margins for a business model that relies on massive, long-term physical assets. If Alphabet fails to monetize these data centers at high rates, the fixed depreciation costs over the next 5 years will act as a heavy anchor, weighing down their return on invested capital. This balancing scale shows the danger of operational leverage. If a recession hits in 2027, advertising revenues will likely fall, but these massive blocks of fixed depreciation and R&D costs cannot be reduced. Alphabet's metamorphosis suggests that maintaining a monopoly in the age of AI requires more than just algorithmic logic. It requires heavy physical leverage. Evaluating companies undergoing these structural shifts requires moving beyond surface-level price-to-earnings ratios. You can access advanced research and deploy your own personal deep value agents by using the Deep Values app. Track total market temperature in real time by downloading the Buffett Indicator on the Apple App Store or Bubble Watch on Google Play. All data is sourced from public filings. This content is for educational and entertainment purposes and does not constitute financial advice.